The big banks are panicking as more rate hikes are bad news. I'm your host, Steve Van Metre, and thanks for joining me today. And while investors are celebrating tighter monetary policy by bidding up risk assets, the banks are panicking as the outlook for them is grim. Let's head over to Bloomberg, where we picked today's story up as U.S. consumer confidence drops to the lowest since February 2021 as inflation bites. And the U.S. consumer confidence declined in July to the lowest level since February 2021 on dimmer views of the economy amid persistent inflation. The Conference Board's index decreased for a third month to 95.7 from a downwardly revised 98.4 reading in June. The steady weakening in sentiment risks causing consumers to cut back on discretionary purchases at a time when the economy is struggling for momentum. But perhaps the data is just telling us that consumers already are struggling because their wages are not keeping up with inflation, and that is perhaps the reason they're not very confident. Inflation has dented confidence and has forced the Federal Reserve to pursue aggressive interest rate hikes geared at curbing demand. And here we can see in this chart, because how this impacts banks is through lending. And one thing you hear central bankers say is, wow, but lending is so strong. There's a huge demand. There's a lot of credit creation. But this tends to be a late cycle issue. In fact, it tends to be a lagging issue. Now, we don't have the Conference Board's data in the Fred database, but we do have the University of Michigan consumer sentiment showed here in red. And against that, we'll run the commercial industrial loans on a year-over-year rate of change in blue. And as you can generally see, they're fairly in sync with consumer sentiment, leading the year-over-year rate of change in commercial industrial loans lower and then leading it back higher. And in the last recession, of course, we can see consumer sentiment tanked, and then with a lag, of course, lending collapsed with it. Now you see central bankers excited, but perhaps this excitement is soon to go away, as you'll see later in this show. New home sales fall more than forecast to two-year low, another dent to the outlook for banks as purchases dropped 8.1% in June to an annualized 590,000 rate. Other data Tuesday from the Conference Board showed the share of consumers planning to buy a home in the next 6 months dropped to 4.4% in July, the lowest in nearly 7 years from 5.7%. And overall consumer confidence fell to the weakest point in February of last year on dimmer views of the economy because of inflation. And of course, we know that banks love home loans. They're big loans, and that means big profits for banks. And as, of course, buyers dry up, and that has an impact on the amount of loans that they're going to take, and in turn, bank profits. New home sales report produced by the Census Bureau and the Department of Housing and Urban Development showed that the median sales price of new home rose 7.4% from a year earlier to $402,000. It marked the smallest annual gain since November of 2020. So home prices are still rising, but as they go up, demand for them is falling quickly, telling us the prices are too high. But how does this again impact the banks? Well, again, it comes back to lending, and if people aren't buying homes, they're not getting mortgages. And in this case, what we see on this chart is we see new one-family homes sold in blue, which is slowing at a declining rate of change, is also falling as well. And against that, we see that real estate loans in red tend to lag that, which makes sense. People buy a home and get a loan. And of course, on a year-over-year rate of change, the real estate loans is going to lag. But you'll notice, even though the data is choppy, they still follow each other, telling us that real estate loans are headed much lower. And what we then do is now look to our chief strategist, Jeff Snyder, to get his take on what's going on with new home sales. And he said, should the housing market begin to reverse, then any intangible benefits the economy accrued over the preceding years would likely dissipate. Falling to these levels for new sales indicate a substantial issue in the housing market that make price reversal a greater possibility and therefore a higher chance of negative pressure on sentiment channels. Now, if you'd like to read Jeff's research, my research, and Tracy's, well, there's a link in the description below for Market Insider Pro. You can check it out in your time in the future. Next report due 8:30 a.m. tomorrow. Mortgage demand declines further even as interest rates drop a bit, giving another blow to the big banks as total volume was down to 1.8% last week from the previous week, according to the Mortgage Bankers Association. Applications to refinance a home, which is key profit center for banks, fell another 4% for the week and were 83% lower than the same week 1 year ago. The average rate on 30-year fixed mortgage rate was 3.01%. Most borrowers have already refinanced, as we've said on this show, to far lower rates than exist today, meaning they have no need to actually refi. But more importantly, as we see these refinance applications dropping, what this means for the long bond, what it means for interest rates is they tend to fall. And I've gone back here on this chart and marked periods in yellow where we see actual peaks in or troughs in borrowing. And what it means is rates are likely to fall from this point forward, which is actually not something the market or the Fed is really expecting here. And if you're concerned what a housing-led downturn as the banks look to tighten their financial conditions, which I'll show you here in a bit, could mean to your portfolio, well, you shouldn't be. There is one strategy out there that hedges with bonds. I'll put a link up here in the corner and the description below. It's called Portfolio Shield. Now let's take a look at what happened with the Fed today, because they did raise rates by 0.75%, and that was right in line with what markets were expecting, as officials agreed on Wednesday to a 0.75 percentage point rate hike, which will lift their benchmark federal funds rate to a range between 2.25% and 2.5%. The rate increase won unanimous backing from the 12-member rate setting committee, something that doesn't happen all too often. In a policy statement after the conclusion of their meeting, officials acknowledged signs of a slower economic activity since they met last month, and recent indicators of spending and production have softened. Nonetheless, job gains have been robust in recent months. The statement repeated language from the previous meetings that said officials anticipate additional rate increases will be appropriate, and in the press conference, we heard that from the Fed as well, saying that it is likely that they will keep increasing in the future, but perhaps they may not be as much depending on what the incoming data says. What's important is we noted they said there's a slowdown, and Powell said this is exactly what they wanted to see. They wanted to see the economy slow down to bring demand down to the level of supply. But how does this all translate back to the banks? Well, hang tight, because one of the biggest questions I get is, can interest rates fall, particularly on the long end, when the Fed's tightening? And the answer is absolutely. And here we can see the federal funds rate in blue and the 30-year long bond treasury yields here in red. And we can note there are periods during hiking cycles when rates on the long bond flatten out and start to fall. Here we can see it's again in 94 happening, going into the dot-com bubble it happened, leading, of course, the whole hiking cycle starting in 2005. Rates went down, then went flat, and then, of course, came crumbling down. We see this happened again back in 2018 as rates decided to head lower. And all that's telling us, if you want to understand what this means, is that the bond market is saying that the Fed is going too far, and the fact that they're going to end up cutting rates in the future, and the bond market, of course, being a lot smarter than the Fed. Now, how does this all come back to the banks? Well, it means that financial conditions are tightening. It also means lending standards are going to soon tighten. As you can see from this chart, when we look at the yield curve, and right now we see in purple, the yield curve is inverted, meaning short-term rates are actually higher than long-term rates. And while this connects back to the banks, I want you to understand the banks borrow at short-term rates and they lend at long-term rates. So short-term rates are higher than long-term rates, and they don't make any money. And so what that means is they start tightening lending standards, as I want you to see here. And you can note that during periods of a inverted yield curve, you can see lending standards here in these other lines that I've got colored in here. These lending standards start to rise, and what that means is they get tighter, and then all of a sudden you see interest rates collapsing at a time when banks are tightening lending standards. And this isn't actually what most people think happens, but generally we can see in every case when the curve is inverted and then starts to go up, it means lending standards are going to tighten. We see it over and over again. And how does this translate into the Fed making a huge policy mistake and what the bond market sees? Well, we can see here now we have the yield curve again, now this time overlaid by the consumer price index in blue. And our chief strategist, Jeff Snyder, says that a deflationary recession is coming. Is he right? Well, the yield curve is just another way to show that, yes, he's right. We can see when the curve goes from periods of inversion and starts rising, and that means yields are falling. You'll notice inflation's coming down, inversion, curve rising, inflation comes down, inversion, curve curve rising, inflation coming down. Here we see curve not quite inverting. Inflation came down, curve inverting. It tells us that things are not going to be good for the banks. It means they're going to have to tighten lending standards. And when banks tighten lending standards, rather than backing deposits with loans, they start backing deposits with bonds, meaning they turn into big buyer bonds. Rates start to head lower, and disinflation and perhaps a deflationary recession is coming, something the Fed says isn't going to happen, and they're about to be surprised. I'm Steve Van Meter. Thanks for watching. Thanks for being fans. Bye now.